You've done well. You built wealth, saved consistently, and invested wisely, probably with a portfolio of stocks, bonds, and mutual funds. But here's a problem many high net worth investors eventually face. The more money you have, the less confidence you may feel in the markets. Because when the market drops 15 or 20%, you're not just watching numbers on the screen. You're watching retirement goals, your legacy plans, your exit strategy suddenly feel like they're on shaky ground. And that diversified 60-40 portfolio is still 100% tied to public markets. And that means you're still exposed to volatility, interest rate swings, inflation, and tax inefficiencies. So what are the wealthiest investors doing differently? They're expanding beyond stocks and bonds. They're using private real estate, private credit, structured income strategies, and DSTs to build portfolios that are more resilient, more tax-aware, and more stable, even in unpredictable times. In this video, I'm going to walk you through exactly how smart investors are building smarter portfolios, not to chase returns, but to reduce risk, simplify decisions, and create long-term confidence. I'm Ryan Glasgow, founder of Glasgow Investment Solutions. For over 20 years, I worked with real estate investors, high net worth individuals, and business owners across the country to create customized strategies for building and preserving wealth, especially through 1031 exchanges, DSTs, and alternative or private investment solutions. If you're looking for ways to grow your wealth while minimizing unnecessary taxes and complexity, this channel is built for you. Make sure to like, comment, and subscribe for more clear, strategic insights like this. What alternative investments really mean? When people hear the term alternative investments, they often assume it means risky, unproven, or overly complex. But here's the truth. For high net worth investors, alternatives aren't exotic. They're essential. They're not about chasing the next big thing. They're about adding stability, income, efficiency to a portfolio otherwise overexposed to public markets. So what exactly are we talking about? Alternative investments refer to anything outside traditional stocks and bonds. For our clients, that often includes private real estate, private credit or direct lending, Delaware statutory trusts or DSTs, structured notes and fixed income strategies, trust-based tax and estate vehicles. These aren't speculative bets. They're professionally managed income-producing strategies that offer low correlation to market volatility, predictable cash flow, and in many cases, significant tax advantage. Why it matters: if your portfolio only includes public equities and bonds, then every market movement affects your entire financial life. When the market drops, you worry about spending. When interest rates shift, bond values slide. When taxes go up, your income plan gets squeezed. But with the right alternative investments in place, you start to build financial insulation. You create layers in your portfolio, some for growth, some for cash flow, some for estate protection. And that's what smart diversification really looks like. Here's a real client scenario. One couple we worked with had done everything by the book. They had $3.8 million between IRAs, taxable brokerage, and a few bond lenders. But in volatile years, they found themselves tapping into their equities just to maintain their income, selling shares in down markets, creating a tax drag, and compounding stress. We helped them reposition a portfolio of their assets into a private credit fund with steady monthly income, a Delaware statutory trust using equity from a rental property sale, and a tax-managed portfolio overlay to reduce annual distribution. The result? This helped them create a more predictable income stream and reduce exposure to market-related withdrawals. And less dependence on what the market did day to day is great for everybody involved. For high net worth investors, alternatives aren't optional. They're often the piece that finally brings peace of mind. Real estate and DST, income without active management. Real estate has always been a cornerstone of both of them. But as you get older, managing can start to feel like a second job. Many high net worth investors own multiple properties, residential, commercial, or both. They built equity, they collected rate checks, they take a depreciation. But now, they're tired, tenant turnover, unexpected repairs, property taxes, and insurance hate, and the weight of managing everything themselves. And even if you have property managers, you often find yourself managing the managers. So what if you could keep the income without the work? That's where Delaware statutory trusts or DSTs come into play. DSTs allow you to sell a property and defer capital gains taxes using a 1031 exchange. Move into fractional ownership of institutional-grade real estate. Receive potential monthly income distributions, which are not guaranteed and vary by often. Eliminate all active management. You're still in real estate, but now it's passive, professionally managed, and often better diversified than what you had before. A real-life example from a landlord to a lifestyle choice. One investor we worked with owned 3 apartment buildings and a small retail space. He was collecting steady income, but he was also fielding calls from tenants, coordinating repairs, and spend more time managing than enjoying retirement. He didn't want to sell and pay tax. He just wanted out of the day-to-day. So we helped him. We used a 1031 exchange to move into 3 different DSTs. We diversified his holdings across geographic regions and property types. We deferred hundreds of thousands of dollars in taxes, and we increased his monthly hands-off income. Many investors discover it's not the real estate that's the issue, it's the ownership model. DSTs work for retirement planning excellent. For wealthy clients nearing or in retirement, DSTs offer a way to keep earning from real estate, defer taxes, simplify life, and align assets with a long-term income and estate plan. It's a smarter way to transition out of active ownership without giving up the benefits you worked so hard to build. Private credit, reliable income without market exposure. Let's talk about one of the most underutilized and powerful income strategies for high net worth investors, private credit. Now, if you're not familiar with the term, private credit simply means this: you're the lender, not the borrower. You're providing capital to businesses, real estate sponsors, other institutions. And what you get is a contractual interest of income outside of the public bond market. And in today's interest rate environment, that could offer meaningful advantages. Private credit matters. For years, investors relied on bonds for safety and income. But with bond yields struggling to keep pace with inflation and volatility creeping into even fixed income market, many retirees are looking for predictable, risk-adjusted cash flow. Private credit offers strategies that may offer competitive yields depending on the structure, duration, and risk profile. Low correlation to the stock market, so it's not tied to Wall Street swings. And often shorter-term commitments which provide flexibility. And unlike public bonds, many private credit funds are asset-backed, meaning there's collateral behind the limit, which reduces risk. Here's a real example: creating steady market-independent income. We worked with a couple in their early 70s. They had a sizable portfolio just over $5 million, mostly in mutual funds, stocks, and some real estate. Their biggest complaint? Every time the market drops, we feel like we have to pause our lifestyle a bit. We structured just 20% of their non-qualified investments into private credit strategy focused on short duration, asset-backed lending. The result? Steady monthly income. No more withdrawals from their equity portfolio during market dips, and less emotional pressure tied to headlines or volatility. The shift reduced emotional pressure and gave them more flexibility during market downturns. Private credit fits into a portfolio, but it's not meant to replace everything. It's a powerful addition when you want income that doesn't depend on stock prices, diversification that reduces overall portfolio risk, and a smoother ride in retirement. In the same way DSTs provide passive real estate income, private credit provides passive lending income, but without market exposure. And another tool in a smarter portfolio. How the wealthy diversify. I realize some of these strategies may seem new or foreign, but they're not. These are the way that foundations, institutions, and the ultra-high net worth have been investing for 30 years. One of the biggest myths in wealth management is that diversification means owning lots of things. But smart investors, especially high net worth clients, know that true diversification isn't just about quantity, it's about purpose. After all, it was Warren Buffett that coined the phrase diversification. You can't just get a better portfolio by adding name after name after name. We've seen portfolios that hold 20 mutual funds, 3 rental properties, a few ETFs, and maybe some bonds of extend. But when you look closely, everything is tied to the same economic trends, the same tax treatment, the same market movements. That's not diversified. That's a duplicated exposure. What wealthy investors do differently is the most successful investors we work with structure their portfolios with intent. Here's what that looks like: growth assets for long-term appreciation, public equities, private placements, tax-managed ETFs, income-producing assets such as DSTs, private credit, structured income solutions, and finally, tax-deferred and estate planning layers, 1031 strategies, charitable trust, holding companies. Each piece plays a specific role. Some generate predictable cash flow, others minimize taxable distributions, others support legacy goals or future liquidity. They're not just thinking in terms of allocation, they're thinking in terms of design. Another real example: here's a portfolio designed around the lifestyle. One of our clients is a business owner who sold his company in his late 50s, came to us with a large liquidity event and a familiar question: where do I put this where I don't have to stress about it? He didn't want to ride the market roller coaster. He didn't want to buy more real estate you'd have to man it. And he wasn't interested in chasing yield. His portfolio included a foundation of private credit and DSTs to cover lifestyle income, a tax-managed growth portfolio to preserve long-term capital, and charitable strategies to align with his giving goals and reduce his tax burden. This structure allowed his portfolio to align with his income, growth, and giving goals without requiring active management. The takeaway: wealthy investors don't just diversify to protect against loss, they diversify to align their money with their life, with more control, more stability, and less stress. They don't ask, what's the market doing? They ask, what is my portfolio built to do for me? And when your portfolio is structured around your goals, not just market trends, that's when real clarity and control becomes part of your plan. So here's the truth: if you built wealth through business, real estate, or a career of disciplined saving, your portfolio should reflect more than just market performance. It should reflect your goals, your timeline, and your desire for control. And if your entire plan is still tied to stocks and bonds, you may be diversified on paper, but not in reality. Just look at the most recent pullback. Many people were overly stressed because they didn't have adequate diversification. The most successful investors know that wealth isn't just about growing money, it's about protecting it, using it wisely, and positioning it to serve your life. That's why we go beyond the traditional playbook. We build portfolios that include private real estate and DSTs for tax-deferred income, private credit for market independent cash flow, structured cash managed portfolios for legacy and liquidity, and a strategy that brings all of it together. If that's the kind of clarity you're looking for, I invite you to book a time with me using the link in the description below. We'll take a close look at where you are now, where you want to go next, and how we can build a smarter, more resilient portfolio around what matters most to you. And this isn't about replacing everything you have. This is about keeping the best of what you have and enhancing it with things that aren't tied to the public market. Because when your wealth is structured with purpose, you don't just retire well, you live well.